Picture this. The Bank of England, the very pillar of financial stability, is grappling with a staggering loss that no one saw coming. This isn't just a hiccup in the financial landscape, it's a seismic shift, a tremor that has rattled the very bedrock of the UK's economy. Deutsche Bank, a titan in its own right, has made a startling prediction. The Bank of England, in its effort to buoy the UK economy after the financial crisis, has found itself in deeper waters than anticipated. It's like a ship that sets sail with a carefully charted course, only to find itself in the middle of an unexpected storm. The Bank of England purchased bonds, a move akin to throwing a lifeline to the struggling economy. But the storm was fiercer, the waves higher than expected. The central bank estimated it would need a backstop of £150 billion from the UK Treasury for its asset purchase facility, a scheme that ran from 2009 to 2022. But the costs have surged, rising more sharply than anyone could have foreseen. Why the sudden increase? It comes down to the age-old issue of inflation. To combat it, the central bank had to tighten its monetary policy, and just like that, expenses spiraled, reaching heights that dwarfed the initial projections. The Bank of England has been on a rollercoaster ride, raising interest rates at 14 consecutive meetings, reaching a 15-year high. It's like trying to steer a ship through a storm, battling wave after wave, hoping to reach calmer waters. But this financial tempest has left a significant dent in the public finances, casting a long shadow over the government's ability to make spending or tax-cutting pledges ahead of the 2024 general election. This is not just a simple loss, it's a financial quake that has shaken the very foundations of the UK's economy. To fully grasp the seriousness of this situation, we must journey back in time to the origins of this financial fiasco. In the wake of the financial crisis of 2008, the Bank of England sprang into action, launching the Asset Purchase Facility in 2009. This initiative was designed to support the UK economy, which was reeling from the impact of the crisis. The Bank of England began purchasing bonds, a move aimed at injecting liquidity into the market, reducing the cost of borrowing and stimulating economic growth. As we fast forward to 2022, the Bank of England made the decision to unwind its position. It began selling the bonds it had accumulated over the years at a projected pace of £80 billion per year. This move was part of a strategy to normalise monetary policy after years of extraordinary measures taken to support the economy. However, the Bank of England was faced with a pressing issue: inflation. Inflation rates were rising, and to combat this, the bank had to tighten monetary policy. This meant raising interest rates, which it did in 14 consecutive meetings, reaching a 15-year high of 5.25%. The need to combat inflation led to costs rising more sharply than anticipated. The Bank of England estimated that it would need the UK Treasury to backstop £150 billion of losses on its asset purchase facility. The Treasury stepped in, transferring £30 billion to the bank so far. However, indemnities are likely to continue exceeding government forecasts. As we enter the fiscal years of 2023 and 2024, the cost to the Treasury of indemnifying the bank over these years is estimated to be £23 billion higher than forecasted. This totals to £48.7 billion for the current fiscal year and £38.1 billion for the following year. Despite these increased costs, there is a silver lining. Stronger government revenues may help offset the increased cost. However, the magnitude of the losses and the uncertainty around the final cost have cast a shadow over the UK's economic outlook. And thus, the stage was set for a financial debacle that would send shockwaves through the UK's economic landscape. The aftershocks of this financial quake are far and wide, affecting every corner of the UK economy. The losses incurred by the Bank of England have left a significant dent in public finances. A dent that only deepens as the costs continue to exceed government forecasts. For a bit of context, let's rewind a tad. The Bank of England, in an effort to support the UK economy after the financial crisis, purchased bonds, lots of them, The expectation was that the UK Treasury would backstop £150 billion of losses on this asset purchase facility, which ran from 2009 through to 2022. But as we know, expectations and reality often diverge. The Bank of England began unwinding its position last year, selling bonds at a projected pace of £80 billion per year. However, the costs have risen more sharply than anticipated due to the central bank's need to tighten monetary policy to combat inflation. The Treasury has transferred £30 billion to the Bank of England so far, and indemnities are likely to continue exceeding government forecasts. But let's talk numbers. The cost to the Treasury of indemnifying the Bank of England over the next 2 fiscal years is estimated to be £23 billion higher than forecasted, totaling £48.7 billion for the current fiscal year and £38.1 billion for the following year. This financial strain could impact the government's ability to make spending or tax-cutting pledges ahead of the 2024 general election. These pledges are often seen as key selling points for parties vying for power, and the ability to fulfill these pledges could sway voter sentiment. However, it's not all doom and gloom. Stronger government revenues may help offset the increased cost. In the grand scheme of things, this situation serves as a reminder of the delicate balancing act that is economic policy. The ripple effects of these losses are indeed profound, casting a long shadow on the UK's economic future. But as they say, every crisis presents an opportunity, and so we ask, what are the potential recovery strategies for the Bank of England? In the face of this financial predicament, it's crucial to consider the various approaches available to the Bank of England. One such strategy involves the pace at which the bank sells its bonds. A gradual, measured approach to bond selling could help stabilise the market and mitigate potential losses. Another recovery strategy lies within the realm of monetary policy. The Bank of England has the power to adjust interest rates, which can have significant effects on the economy. By carefully calibrating these rates, the bank can influence borrowing costs, investment and spending, all of which play key roles in economic recovery. In recent times, the Bank of England has been on a steady path of rate hikes, with 14 consecutive meetings resulting in an increase. This has led to a 15-year high of 5.25%. Although this tightening of monetary policy is a response to inflation, it also presents an opportunity to recoup some losses. Then there's the role of stronger government revenues in offsetting the increased costs. As the economy recovers, the government will likely see an uptick in its revenues. This additional income can be used to balance out the higher-than-expected costs incurred from the Bank of England's bond losses. In addition to these strategies, there's also the possibility of selling back all the government debt the Bank of England has purchased. However, this is a strategy that requires careful consideration. The timing and scale of these sales could significantly impact the bank's profits and losses, as well as the overall health of the economy. It's important to remember that these recovery strategies are not mutually exclusive. A combination of these methods, tailored to the current economic climate and future forecasts, could provide the most effective path to recovery. The road to recovery may be long and arduous, but with strategic planning and effective policy changes, the Bank of England can steer the ship of the UK economy back on course.